Well, good morning, everybody. Thanks for making some time for us. My name is Joe Heins. I'm special counsel at Phillips Lytle in Buffalo. And this is our Phillips Lytle Real Estate Institute webinar series. It's our second session. And this one, we're talking about recent trends in real estate development and financing. I'll introduce our esteemed panel, or I'll have them introduce themselves in a minute. But first, I just wanted to handle a couple of logistical items. So we're in a webinar format, so all the participants are going to be muted. They're going to be, won't be able to see your video. It's nothing personal, just the way it's set up. But there is a chat on the side where you can ask questions. Those will come through to me, and I'll try to disperse them to the panel. So if you do have any questions, please put them in that chat, and we'll do our best to get to it. We have an hour, so there's a lot to cover. We're going to try to do our best to cover all the different aspects of it and get to as many questions as we can in the hour. Just a brief outline. We'll start with kind of an overview of the state of the market, talk about where things are, the lending environment, cost of capital at the moment. And then I think the meat of the presentation is going to be, all right, what are some of the current strategies that we can use right now to get projects done? We're in a bit of a challenging environment, I think we'll find. And so what can we do from all these different perspectives to bring together the capital stack and get these things done? That'll include incentives, different structures, and things like that. And then hopefully we'll have some time at the end for a little crystal ball and have some predictions from our experts here to see what they may think is happening in the future. And before I forget, because I probably will at the end, we will have our third session of the Phillips Lytle webinar series that's going to be on June 24th on data centers. So more on that to come, but hopefully you enjoyed what we do today, or we don't screw it up enough and you come back to the next one. So we have a great panel today. We have attorneys, we have lenders, brokers, end users, and developers. So I'll let them introduce themselves. A couple of us are in the room. I'll have a special shout out to Russ Gentner, who I'll let go first, who got in very late last night on a delayed flight, but still had the commitment to come and show up and to help us out today. So we appreciate that, Russ, and I'll let you start out and just tell us about yourself and your role.
Thank you very much, and good morning to everybody. My name is Russ Gentner. I'm the Director of Commercial Real Estate for CNB Bank, which is the parent company of BankOnBuffalo. So for those folks in Buffalo, you know us as BankOnBuffalo. So what I do is I work with all of our commercial real estate lenders throughout our bank's footprint, which includes Columbus, Cleveland, Pennsylvania, and all the way to Virginia. And I work with the lenders to try to help structure deals and also sit on our loan committee. So thank you very much for having me. I'm looking forward to the discussion.
Absolutely. All right. So when we set this up, I didn't think it all the way through, but we have Tom and we have Tom and we have Tim. So I'll do my best to keep it in line. But Tom G, why don't you start us off?
Good morning. Thank you for the invite and being a part of this panel. Tom Grzebinski, and our firm is Gantry. We're a national commercial mortgage banking firm. We have 13 offices across the country. Here in upstate New York, we have an origination team along with one in New York City as well. And the majority of our business is arranging financing using the different buckets or silos of lending sources. That includes life insurance companies, which is about 60% of our business. That's the CMBS loans, the security loans, debt funds, local banks, and agencies. So Fannie Mae. We've done $1 billion the first quarter this year. Our originations for last year was over $4 billion. And one of the differences between Gantry and some of the other shops is that we service the loans for our correspondent life insurance company. And what that means is that we're taking the payments, we're doing the tax escrows, we're doing the annual property inspections. That portfolio is approximately $24 billion. It's just over 2,200 loans. And knock on wood, it's perfectly performing. There's no leaks within that portfolio.
Or Tom Ivancic. I'm the director of capital markets with Good Carbon. Good Carbon is a net zero carbon vertically integrated developer. We have our own development team, our own construction team. We self-perform on 80% of our projects, and then our own property management company as well. All of our projects are in the multifamily space, focused on existing property purchase and renovation with a net zero carbon focus. My background is actually on the lending side. So I was a lender for 15 years before being asked by Good Carbon, who was at the time a client of mine, to switch sides of the table and join them in-house. Most recently, I was at BankOnBuffalo with Russ, and then I've been at a few other shops, including in Boston for a while, before moving back to Buffalo 10 years ago. I live up in Lewiston with my wife and 3 kids, and excited to be here today. Thank you.
Not least, we have the lawyer on the panel.
Always last. Tim Moriarty, partner Phillips Lytle in the land group, co-chair of the real estate team with Joe. Joe, thanks for setting this up today. You know, my practice is pretty much primarily all transactional work, so buying, selling, leasing, title review, and due diligence. I think the role here on the panel today is just not to try to outbroker the broker or the lender or the developer, but just to try to offer, you know, practical legal execution solutions, you know, how deals are being papered currently, what I see in diligence, how financing is playing into it, incentives. The biggest thing is probably risk allocation and how deals are getting closed. So happy to be here and looking forward.
All right. The feedback initially from the chat is if you guys just get the microphones a little closer. But Russ, you're sounding great, so we're on track. All right, so state of the market. We'll open it up kind of a general question. How do you characterize the current commercial real estate market? What are you seeing as far as trends, things going? I'll start with you, Tom G, and work our way down.
The overall real estate market is doing fine. I would say 2 weeks ago, it might be even have been doing better. The 10-year treasury has run up pretty significantly recently. Every lender, there's actually more capital chasing deals right now than there's been in the last decade. And that is whether it's national lenders looking to increase their holdings, their loan holdings, or the local banks just trying to grow their portfolios. So access to capital isn't the challenge. It's finding a structure that fits in the box of the lender. That's the challenge.
So we'll talk a little bit more, I think, about structures later on. I know everyone's kind of got their areas, so maybe Tom, you focus a little bit more on the local market. And I know there's folks in the audience who are probably maybe a little bit skewed towards the Western New York, upstate New York market, but I know there's also some national folks from around the country who've joined us, so we'll be sure not to forget about you. So I guess, Russ, I might throw it to you on that note to say, maybe what are you seeing from where you're sitting, and maybe from a little bit of a larger national perspective.
Okay, thank you. Yeah, and I would agree with Tom. There's, you know, community banks in particular, you know, have capital available. And the community banks over the years on a national level, and currently, if looking at the portfolios, finance, you know, around 50% of all the CRE loans. So there is capital available. I think what's changed a little bit is, you know, the rules and regulations. And, you know, banks are in a position where they have capital, they want to lend it, and we are lending, but there have been some changes in the rules and regulations relative to, you know, banks' liquidity and capital, and, you know, how much of our portfolio can be in commercial real estate. And that gets watched very closely. So most of the banks, you know, as Tom said, have capital. We want to lend it, but we need to stay within certain parameters because no bank wants to be labeled as overweight in commercial real estate because that then represents a host of issues. So it's kind of, I would correlate it though to the development community where a developer goes out and raises capital and wants to deploy it as soon as possible. They have investors that are expecting a return. It's the same thing with banks. You know, banks shareholders are wondering what you're going to do with capital. But you have to be careful how you deploy it and pick the right spots. So I think there's money to lend. We're a bank that's looking to grow in commercial real estate. We have been growing. We've been very consistently growing, but we want to grow with certain control. And we want to be careful not to reach too far to make some deals work that really don't pencil out cleanly.
And so, Russ, if I'm hearing you right, it's not, when you say rules and regulations, not necessarily governmental laws, anything like that. It's more the internal, how the banks want to deploy their capital and how much different risks in different areas they want to take on. Is that right?
Yeah, that's true. There are, I hate to, when you start talking about regulators, it kind of sounds like, an excuse, like why can't you do this or that? Well, the regulators want us to do something. And while that's true, banks still have to control their own balance sheet and figure out the right ways to deploy capital and, pick the right spots. Commercial real estate for the community banks, us included, has been an area of growth. And we want to continue to maintain that, into the foreseeable future. But in doing that, we just have to be selective.
Fair enough. So, Tom, are you seeing similar trends locally? Is there anything particular to this market that may be different from what we're hearing there?
No, I think Tom and Russ, and if you can't hear me, please continue to remind me in the chat to keep this mic up. But I would agree with Tom and with Russ that I'm certainly seeing that. I think to a certain extent, there are, banks looking to deploy capital. And to a certain extent, one of the things I'm seeing is there's a heavy amount of competition for sort of those best deals. And one of the things that I've found that has been working well is not every bank that's looking to grow is going to land every low leverage, A sponsor, easy deal. And so if you kind of lean on the relationship side and have a strong story for your project that may be slightly higher leverage, or maybe you're not an A sponsor, having those relationships and a strong story that you can present to the bank that maybe lost that deal that they were competing for while looking to grow, they're still looking to grow. And so that leaves an opening, I think, for someone who, again, is not maybe an A sponsor or needs slightly higher leverage. I'm seeing a lot of that where, leaning on that relationship side and a strong story, if you have those relationships established with your lending partners, I think that's where you can get more deals done.
So
Hey, Joe, can I jump in there for a second?
Oh, of course.
Tom, I couldn't agree with you more. I mean, a relationship is critically important. And what that means is we know each other. And when banks are looking to, lend money, it's not really just a transaction. It's how well do we know the sponsor? What's the history? What does their global situation look like? And with that type of background, that would allow you to lean into a certain deal and maybe be more aggressive than you would be otherwise.
Well, I think you guys are agreeing with each other too much, so I'm going to try to mix it up a little bit to get a little conflict going here. Following up on that, so when you're talking about the best deals and the competition for the best deal, so are there particular asset classes right now that maybe Tim, may be seeing more deals in industrial, or we're seeing it in maybe not so much in office? So is there particular asset classes, I guess I'll throw it out to the group, where there may be more action than not at this point?
Yeah, I'm just going to reiterate the agreement with these guys over here, just real quick. I had like certain buzzwords in my notes here, and like we hit every single one, so this is great. Yeah, I just agreeing with like the whole. I think like buyers in particular are selectively active right now. The market's not dead, like we're talking about. But what I am seeing is buyers not putting good money after bad, right? So they're being a little bit more careful on their due diligence, making sure everything is lined up first. And as far as we're talking about like asset classes, I think the big money right now, especially in this area, you're probably seeing it in like logistics centers, and you're seeing it in affordable housing opportunities. But the one thing I did want to bring it back to was, Buffalo versus the national market. The asset classes are obviously very different, but the local relationships are the big thing, and that's, I think, the king in the local area, especially in Buffalo, where deals are getting done on a better basis. Yeah, I don't know. And then obviously on the national side, you're seeing data centers everywhere, which I'm not really sure how those capital stacks or the loans work, but yeah, no, it's a very interesting time, and I guess I leave it up to these guys what they're seeing on their assets.
Yeah, Tom.
Having someone that's a local market expert is very important in these types of times where there is some uncertainty. As far as asset types, multifamily continues to be a passion that's being scratched by everybody. And I would argue that retail is also starting to become a darling. The ICSC is happening in Las Vegas. We have a presence there right now. And the feedback that I've gotten is everybody's buying retail. It's becoming hotter and hotter. And there's always going to be a need for a pizza shop and a hair salon and a nail salon and those service types of retailers. The mid-box retail, a little bit more challenging. That 30 to 60,000 square foot retail building is a little bit more challenging to fill. But a grocery anchored center, there's always going to be a need for a neighborhood center as well. Industrial is still considered a attractive property type. Self-storage has cooled off just a little bit locally and nationally. And then I would put hospitality and office kind of in that less desirable category. There's still a home for every loan. It's just a question of what that structure looks like. So that's kind of the hierarchy that I would propose.
So I appreciate you not taking the trip to Vegas and instead being here with us, Tom, and I do appreciate that. So kind of moving on maybe to talk about, some of the strategies. It sounds like, there's deals out there to be made, but definitely not as simple as it may have been 10, 15, 20, 25 years ago. And so maybe, Tom, I'll let you kick it off here since you're on the developer end and putting these deals together. But, what are you seeing as, some of the challenges when it comes to closing the gap on these things?
Yeah, I think, there are still deals getting done, and there is still capital available, but I think the capital stack overall is getting, the more creative solutions are the ones that I'm seeing that are more successful with more layers to it. So the capital stack itself is becoming more layered with a little bit more complexity. Maybe that's due to, debt pressure. If you've got higher rates, pulling back the amount of debt that can come in. And so that gap needs to be filled with, could be grants, incentives, public money, but layering into the capital stack is, I think, becoming a big priority across the board and introduces a certain amount of complexity and challenges with that. But I think that's those creative deals and a layered capital stack are the ones that I'm seeing that are sort of most successful and still getting things to pencil.
Some of the examples, I think, of the capital stack changing over time, when deals were at 4% interest rates or sub 4% interest rates, throw a dart and it's easy to figure out. When the interest rates are 6 to 7, when interest rates are 6 to 7, you really have to put pen to paper. And what's happening is debt service constraint is becoming the dictator of your loan size, whereas loan to value, the cost historically had been the dictator. And either you're going to have a freeze in the market because the deal doesn't make sense, or somebody's going to have to blink. And that means the borrowers either going to have to put more equity in or find more equity, source more equity, or the lenders are going to have to be more aggressive. We're seeing both things happen. We're seeing borrowers having more creative structures, whether it's in an acquisition, a seller holding a piece of the financing, or some kind of an abatement or an inducement from the government. And we're seeing lenders getting more aggressive as well, where 25-year amortizations was the norm, 30 years is the norm for amortization at this point, and a 125 debt service coverage was the norm. 120, or even recently on a multifamily construction, they underwrote it to a 115 debt service coverage to make as many dollars, maximize dollars for the borrower out the door.
So it sounds like there's expected to be some creativity, some flexibility on both sides, from the borrower side and from the lender side.
Agreed, but you need to do it prudently. You can't be cowboys. And Russ, I would ask that you kind of step in and share, how do you grow a balance sheet as a bank when there is some cowboy stuff going on out there? Just one more example is interest only is kind of like normal at this point because everyone's trying to figure out how to make deals work. The deals that were happening 5 years ago and 10 years ago were at a maturity wall at this point. So this year and next year is going to be the most amount of loans that are maturing in the nation, in the history of the last 20 years for sure. And a lot of those loans were 5% loans, 4% loans, 3% loans. So when the economics don't work at 6%, you have to find out how to get these loans repaid. You either come to the table with a check as the borrower, or you sell the asset and dust yourself off and move on to the next deal.
So are you seeing any kind of increase in short-term or bridge financing to say everyone thinks, all right, well, we waited out for a year, we waited out for 18 months, it may be a different environment coming down the line, or has everyone kind of settled in to say, all right, this is a bit of a new reality, 4% might not be coming back anytime soon?
That's the management that we're trying to have with our clients, is that this is a normal interest rate environment. If you looked at 50 years of interest rates, this is the norm. 5 years ago was the anomaly, and we shouldn't expect that to come back. So interest only is kind of the equalizer as far as at least getting everybody out of their loan and kind of kicking the can down the road. And hopefully you have rent appreciation and value appreciation where you can get kind of a normalized loan. So the lower terms seem to be the more attractive lending sorts at this point. 3-year and 5-year money is much more attractive right now than 10 years ago. Everyone wanted to do 10, 15, 20-year fixed deals. Now people seem to want to do 3- and 5-year money just to kind of right size themselves and dust themselves off.
So let me
Russ,
jump
are you
in here,
seeing,
Joe.
Similar things?
Yeah, Joe, let me jump in. A couple of things I wanted to mention was Tom, once again, is correct. And I hate to admit it, I'm agreeing with a broker all morning here, but there were coming out of the pandemic and faced with all kinds of challenges with supply chain and costs and interest rates. There were a lot of loans that were extended short term. And that's what we're seeing now in 2026 is an unprecedented amount of maturities. So the loans that were extended back in 2022 or 2023 were loans that were having a hard time really penciling out. They really couldn't go longer term to make any sense for the lender or the borrower. So a lot of banks did what we call basically extend and pretend. And pretending that in 2 to 3 years later, something's going to improve. And when what everyone was pointing to primarily was interest rates, that maybe interest rates would come back around and they would make these deals pencil out better, and you could get comfortable with a longer term extension. And just back to our friends, the regulators, they're watching this closely and seeing this volume of maturities and being concerned that lenders will start really loosening standards and or will bite the bullet and say, hey, this deal's just not going to work. And that might lead to, an increase in reserves or even losses. So that's a significant risk that, the borrowing community and the lenders have. I just want to go back 1 second, if you don't mind, to asset class and talking a little bit about on a national level. There was obviously a tremendous amount of growth in the Sun Belt area. And what happened was, although multifamily remains a preferred asset class, there was tremendous supply added there. And to the point where now we're seeing a little bit of softness in those markets with some lease concessions, some strain on rental rates, and even an uptick in vacancy. So a question we get as lenders in Buffalo is, when you look around the Western New York market and you see a lot of new construction going, let's say, for example, in multifamily in Amherst. And someone asked me the other day, like, well, how do you know that there's going to be a balance of supply and demand, 3 years from now on what is for Western New York, higher end multifamily? And my answer is always the same. And the answer is, I can tell you exactly what's going to happen. And that is, no one knows. It's impossible to know exactly what the market's going to look like in 3 years. You can get all the market studies you want, all the appraisals, all the experience that a group like this could bring to the table. But you don't know what's going to happen in 3 years. I don't know what I'm having definitively for dinner tonight, let alone what the market looks like in 3 years. And that goes back to what I talked about earlier, is the relationship and knowing your sponsor. So I think the best thing lenders can do is pick the right sponsors. Pick sponsors that are experienced, that have good global cash flow. And when something unforeseen comes up 2 to 3 years from now, those are the type of developers that can weather the storm.
So I appreciate that. So I guess, one of the things that maybe I'm seeing as we're helping guide some of our developer clients through deals is maybe there's a heightened sense of scrutiny on some of the items on the lender side, some of the due diligence items that in the past may have been, I don't want to say check the box, but there was some more flexibility there. So maybe this is a question for you, Russ, from a bank perspective. But are you seeing, especially in the commercial real estate space, a tightening of those reviews of the due diligence to, like you said, if it's a sponsor that has good cash flow, at the same time, taking those extra steps, and some may see them as extra hoops to make sure that a project has the best chance of being successful?
Yeah, I do think, being in this business now for longer than I care to admit, I mean, it was always, location, location, location when people talk about real estate. And obviously that's a major T you need to cross. But we're looking harder at the sponsorship and the borrowers, because, we do have to make, credit decisions. But as we're talking about community banks looking to grow their portfolio, at the same time, you're making a business decision. And you try to blend those two things together and make the right decision. So I think and this isn't necessarily new, Joe. This has been something that's been going on for years, is you really have to take a time out and make sure you understand the borrower. Because in my history, if you do have a problem that comes up, more often than not, it's not on the specific property or project that you financed. The problem is as a result of the broader global picture that the borrower is experiencing, and that's impacting your individual loan. So there's definitely been a trend for many years now, and I'm sure both Toms have seen it, where lenders are doing a much deeper dive into who is the borrower. And, in Buffalo, I will say we benefit significantly from a really deep bench of developers that are experienced, have been through many different cycles over the years, and are making good decisions today as to what type of projects they want to do.
Okay, my battery's dead.
It's just our way of saying.
There we go.
It's enough time.
Test. I just want to hear all the microphone. Everyone give me the microphone. The upstate New York market, that being Buffalo, Rochester, Syracuse, Albany, has seen an influx of national and international buyers coming in and becoming operators. And the reason that that's happening is because we're not the Sunbelt states, we're not the Floridas. The cap rates and the valuations are much more attractive in upstate New York. The cash on cash returns are much more attractive. So more people are coming into this market. It's making your job, Russ, a lot more challenging as a lender, because you really have to deep dive into these new borrowers that nobody knows. So the market is historically, Buffalo developers stayed in Buffalo, Rochester developers, it was siloed, Buffalo, Rochester, Syracuse, Albany. Now they're intertwining across the thruway, and you have all these other developers that are coming in. It's a much different market today than it was 10 years ago.
That's spot on. That's sorry, Tom, but just give me 1 second. That's absolutely spot on. But as a lender, you have to look at, if someone's coming into the market for the first time, that gives you a little bit of pause, because when people coming in from other parts of the country, they look at a market like upstate New York, and they're very surprised at things like cap rates, and they think, hey, look what I can buy here versus what I can buy, in the Carolinas. Well, fair enough, but it doesn't mean you really understand the market. It doesn't make it an easier market to get a return in just because cap rates are different than they might be in a Sunbelt location.
Maybe instead of agreeing with my panelists, which I do, I'll actually ask a question of Russ. Being on the other side of the table now, I'm sure you've heard, or maybe you were one of the ones that told me the teeter-totter between lending and credit that happens within the bank side. There are times that credit is correctly calling out issues, and lending pressure is overriding that. The growth focus, again, I think we saw this a few years ago, coming out of COVID. And that's not the environment we're in today. It feels like from the other side of the table that I'm on now, that we're seeing a tip more toward the credit side, and not that banks or the credit folks are necessarily not looking to do deals, but they are looking for weaknesses, which may be enough to say, hey, let's pass on that one. And again, as you were saying, Russ, be selective about where we put our capital. Is that how it feels on the inside of the bank side to you?
I'll tell you what I think has happened really, say, post-pandemic is, in this business, no matter how long you're doing it, there's always lessons learned. And I'm sure, you guys at Phillips Lytle can understand. I mean, there was a day and age where a set of loan documents would be maybe a 1/4 inch thick, and now it's a foot thick. And so the documents change because you learn different things. And I think with the risks that came up, out of the pandemic, the things that we already talked about, yes, it led lenders to say, hey, look, we got to look hard at the credit issues that we're already experiencing. And it does give you, it does lead to more time spent on that. But I think the community banks, by and large, have done a really good job of balancing the credit risk with the needs of the business. And that's why I think today, community banks still represent, a big percentage of the CRE deals that are getting done. So yeah, the credit risk is always going to be a part of it. But if you can balance that with the needs of the business and pick the right sponsors, I think we can get deals done, and we can get the type of growth that we're looking for.
So yeah, Tim, I want to bring you in here. One of the things, when Russ starts talking about feet tall paper, I think of Tim Moriarty is what I think of. And so, yeah, I guess from a deal side, what are you seeing? What are some things that you wish some of our clients, we love all of our clients, but what you wish some of our clients might have known, or ways to help them through this process when they're getting the deal done?
Yeah, just like Russ was saying, 10 years ago was definitely a different environment, even just on the legal side, where, deals were getting done and financing contingency weren't even, it was more of an afterthought. It's like, oh no, I know I can get a loan. Don't worry about it. Just, let's put pen to paper and get this done. Now, as we mentioned, lenders are scrutinizing more than just the property itself. Sponsor strength, leases, tenant credit, etc. So, doing your due diligence a little bit ahead of time obviously helps. It gets the ball rolling early. And then from my perspective, my job has gotten tougher over the years, and no complaints on that. But, it's just so much more coordination on the attorney side to make sure that the timing matches what's in that agreement that is ultimately signed. Rate locks, commitment expirations, if you're talking about incentives with IDAs or municipalities, banks are being more diligent on surveys and title and environmental reports. All that needs to be considered on my end when I'm, advising a client, from the effective date of any agreement to closing. There's a lot that has to happen in between there. And the more we can get ahead of that foot of paper, the better for everybody.
You mean I'm shocked to hear that when you sign the contract, it doesn't mean that you're closing next week. No, when are we going to set the closing date?
Yeah, can we make everyone aware of that that's listening?
That's the main point of the whole webinar.
Yeah, there's not too many quick closes anymore, Joe.
Fair enough. All right, so I want to shift a little bit. We've spent a good deal of time. I think it's a great conversation about some of maybe the more traditional bank lending. But Tom G, I know a lot of the work that you're doing is potentially in more non-traditional lenders. And so maybe if you could talk a little bit about that, and maybe if there are some differences between what we've been talking about and deals where it's a non-traditional lender or a non-traditional capital source. Does that change anything here, or is it kind of in the same stream?
Absolutely. There's different buckets of money available. The local bank bucket is the one we've spent the majority of the time speaking about. There's debt funds that are available also, and the amount of debt funds has exploded over the last 10 years. There's two types of debt funds. There's the family fund, the discretionary fund, where where that money is coming from. And then there's another group of folks that are out there, and they have a warehouse line with a large bank, and then they're borrowing at prime, and they're lending it out at double-digit rates. That's challenging because you really don't know who your lender is at that point. Your lender is beholden to their lender. So these family funds, they're pretty disciplined in terms of what they want. And one of the examples is there's a family fund that we've been using across the state. They have a preference for only multifamily, 1 million to 25 million. They'll be at 70 to 75% loan to value, but it's 5 years interest only, non-recourse. And in the event of a loan that's coming up for maturity that was done 10 years ago or 5 years ago, and it can't get taken out by a local bank because the debt service isn't working, here's an alternative for you, because they're not as concerned about the debt service with an interest-only loan. They're assuming that there will be some sort of appreciation in value of the property over the 5 years. The other buckets that are available are Fannie and Freddie, Fannie Mae and Freddie Mac, your agency lenders. They're very attractive, again, on multifamily property only. And then Wall Street, CMBS, securitized loans. They're more challenging as far as the closing process, and they're more rigid, but you're going to get more dollars. If you need more dollars on a deal, CMBS is typically the way that you would be able to achieve that. And then the last bucket would really be the life insurance companies. If you have a stabilized asset, you don't need the last dollar. Typically, life companies had been 10-year fixed rates, but they now read the market. They'll go to that 3, 5, or 7-year fixed rate also. So there are different options depending on what your needs are as a borrower. The missing piece of the capital stack, it's filled. There's a huge disconnect. Everybody that's selling a property thinks they have a Taj Mahal. Everyone who's buying a property is picking peanuts out of poo and thinking that it's a piece of junk that they're going to add value to. And so there's a disconnect in value for what the buyer wants to pay, what the seller wants to sell it for. And we're seeing a lot more loans where the seller is holding a piece of note as a subordinated loan or a personal loan to the buyers. That's how some of these deals are getting done at this point.
Yeah, I think, we're certainly seeing scenarios where sellers want 3 years ago pricing and buyers want 3 years ago interest rates. We talk about that on our side. One question though for you, Tom, is you mentioned the two types of debt funds, and I'm not as familiar with this side of the market. How do you is it easy to differentiate between those family offices you mentioned and the warehouse ones just based on that rate, or is there more to it than that?
You have to peel the onion and understand who your lender is. And inevitably, if we present a term sheet, we should know who the lender is and how they're getting funded. And we would explain the risks to the borrower in terms of how to move forward with this lender.
Okay. And then you mentioned the CMBS market is resulting in more dollars. What specifically is driving more dollars in those facilities?
So they'll underwrite, especially on a multifamily, they'll underwrite to a 1.25 debt service coverage on the interest-only payments, no amortization at all.
Oh, interesting.
So that's how you're getting more dollars. And then they'll also offer where you can do a buy down. And on a 5-year deal, if you pay a 1% fee, you could get 25 basis points off your rate, which increases or decreases your debt service coverage number, increases your loan size.
I see. So an upfront fee, buying it down, but increases proceeds.
Exactly.
To
And
compensate.
it's not even just 1 point. They can do 2 points or 3 points, whatever you need. That's one way that you're getting those dollars.
Interesting. And then the last question I had based on what you mentioned was, you said that the life cos would have slightly less proceeds. If that's the case, what would make a life co attractive as an option compared to the CMBS that has those other pieces you just mentioned?
Rate. A life insurance company, by structure, they're taking all of our premiums for our monthly life insurance policies, and they have to deploy that. They could click the button and buy a bond that's only going to give them a certain return. They need a bigger return than that. So they take alternative risk, which is in mortgages for commercial real estate. Life companies are not the most aggressive people in the world, so you're going to get a lower leverage deal, but your rate is going to be 50 to 100 basis points better than a local bank or a CMBS loan for sure. And so the local bank / CMBS loans are probably like 6% to 6.5%. Your life company is going to be like 5.5%, somewhere in that area.
Okay.
And that's with today's treasury, which is up about 50 basis points from the beginning of the year.
And do those track treasuries? Are they experiencing the same volatility in the last, month and frankly 6 months?
Right. So a life insurance company is going to rate lock at application, and it will be indexed off of the treasury. So the corresponding treasury. If you have a 5-year deal, it's a 5-year treasury. 10-year deal will be the 10-year treasury.
Interesting. And so these are moving around, pretty substantially recently.
Agreed. And so spreads are also changing as the risk appetite is changing in the overall market. So you do have a little bit of volatility that's been happening. There's a lot of macro things that are happening that are creating a ton of uncertainty in this overall market. So one of the certainties that life companies does offer is that rate lock at application.
Gotcha. How long is it from application to close then that you have that rate lock?
75 to 90 days.
Okay. Gotcha.
If you need it faster because of a purchase, et cetera, we could expedite that, but a normal regular fluid process, 75 to 90 days.
Okay. And you mentioned that margins are changing. Are you seeing margin compression, or is rates, potentially move up? They're being compressed, or rates are coming down and you're seeing a bit of margin expansion?
I don't think that the rates are moving down right now. The 10-year treasury is significantly up from the beginning of the year. The spreads are going down mildly, but not basis point for basis point.
Interesting.
So in aggregate, net rates are creeping up. It's not 50 basis points, but maybe it's 40 basis points moving upward.
Interesting. And then on the agency side that you mentioned, how does agency fit in, Fannie Freddie, into that equation between the life cos and the CMBS?
So a Fannie or Freddie execution is wait for an acquisition or for a stabilized asset. They will be almost a hybrid. You'll have on a 5-year deal, 1 year of interest only, followed by a 30-year amortization. On a 7-year deal, you get 2 years of interest only, and then amortization thereafter. And on a 10-year deal, you get 5 years of interest only, and then 5 years of amortization. Okay. So kind of a tweener. It is all just multifamily. It is all non-recourse.
Gotcha. And I'll ask one more question and then stop peppering you with questions and let Joe continue. But this is a side of the market that
Doing great.
I don't know quite as well. So again, I'm curious about it. Obviously, we've been talking terms, structure, rate, those components. What about the additional complexities, close time, future requirements, compliance requirements that are added with any of those options we've been talking about?
Absolutely. They're all going to require annual internal financial statements. Some of them will require some sort of a reserve or escrow structure, whether it's taxes, insurance, or replacement reserve. It just depends on how old the assets are and where they are on the leverage stack. As an example, Fannie Mae, if you're a lower leverage, you can get all of your reserves waived for lower leverage requests. If you have a blanket insurance policy, you can get insurance escrows waived, et cetera. CMBS is a little more rigid. They have quarterly financials, internal statements, but quarterly financials required. In all instances, there are annual inspections for the life insurance companies and the correspondent lenders. Gantry does the inspections for our portfolio. And they're really looking at the bricks and sticks as opposed to they care about the overall relationship, but not to the extent that a local bank would, because it's just a different bucket. It's a different lending practice. There's definitely a need for local banks and credit unions. They serve a huge purpose, but if you have a stabilized asset, you can put it in the stabilized market. And one last differentiation, we talked about debt funds. Debt funds are also good for construction financing. It's an alternative to your local bank. If you have a borrower that has a storied history with some noise or some flies in their history, and you have a borrower that has a need for additional dollars that are not being constrained by high volatility commercial real estate, HVCRE, you can use a debt fund for your construction financing. You're going to pay a double-digit interest rate, but you're also going to get 90% loan to cost. And generally, it's non-recourse. Sometimes they do ask for recourse. So if you need to get in the capital stack a little bit higher than a local bank, you have an avenue to do that.
Are those still then debt service constrained or more focused on the 90% loan to cost?
90% loan to cost. The debt service constraint is depending on which lender it is. We did one in Saratoga Springs that was pretty meaningful. It was like 60 million bucks plus or minus. And that one was a 90% loan to cost. It did have a 125 debt service coverage. The lender required an appraisal to go out 3 years on a pro forma basis. So we were able to pick up some rent appreciation under certain assumptions. Okay. And for that submarket, it's a little bit different than a Buffalo or Rochester or Syracuse. It's just a little bit faster growing market than the other markets of upstate.
Sure. Do you happen to remember what they used for rent appreciation?
Oh, what's that?
Do you happen to remember what they used for rent appreciation 3 years out?
No.
No worries.
I think you guys are like, there's a Tom and Tom podcast coming down the line. It's going to be great. You guys should set it up. That's good. But so I hate to interrupt, but we do have a couple of questions from the audience. So Shayna, thank you for being our question person. So we have one. So are you, I guess this would be for the whole panel, are we seeing more deals fall apart during due diligence? And if so, is it due to financing or other factors? So I guess maybe, Russ, is there anything you're seeing as far as, more deals, having a commitment, but ending up not closing, and what may be the reason for those?
Yeah, we are seeing some of that. I mean, our bank tries to take the approach that if we have a sponsor that we want to work with and we like the project, we may not be able to deliver every component of the deal that the borrower is looking for, but we will put a term sheet out and tell you what we can do. And sometimes it's for one reason or another that's not enough. We also see deals that, we have a deal very unfortunately in another market right now where we committed to a deal and we were probably within 30 days of closing. But the borrower and the partnership group decided they wanted more leverage than any bank, quite frankly, was willing to do. So they switched to a debt fund. And they ended up paying an interest rate that was more than 2% higher than what we were offering. But based on the needs of the partnership, they wanted that leverage. So, sometimes deals do fall apart. And in that discussion between the two Toms, as a banker, I appreciate it because, having all these different sources of capital, although it's competitive and sometimes we lose a deal, it's good for the overall marketplace. And that essentially lifts everyone up. So I welcome that type of thing.
Russ, when you see a deal like that falls apart, and again, they're prioritizing dollars over cost, is the conversation on the bank side, are you discussing ways to increase those dollars and potentially to increase the cost to the borrower to try to accommodate that, to compete with the debt fund in that scenario? Or is it just not a fit in the banking world and better to let it go to that debt fund?
That deal was heartbreaking because no lender wants to get to the point where you have a signed commitment and you're within 30 days of closing and then it blows up on you. But it was the type of deal, long story short, that, there were multiple banks involved in the deal. We were the lead lender and none of the banks were willing to go to the leverage point that ultimately another lender provided. So we had no choice but to walk away from that one.
Yeah, makes sense.
So Tim, I think from a legal due diligence perspective, on Shayna's question, have you seen an uptick of deals, be it environmental or the cash flow rent roll doesn't check out like it should have? Are there specific items that are more commonly killing deals at the moment, or a little bit more of the same?
Yeah, so from the financing perspective from my end and like incentives, that should be one of the first things worked out. So that should be accounted for in the contract, where if financing or incentives are necessary for the project to get done, then the contract should stipulate that. And so, you have your out. So I haven't seen deals being killed over that yet. But we're talking about what was like 10 years ago versus now. I hear the term penciling out a lot more now. And I am seeing deals being killed by really stringent due diligence, whether it be really diving into tenant leases, environmental, especially in this Buffalo area with old industrial, manufacturing, dry cleaners, it can be an issue. Or really a lot of it is just getting boots on the ground, national buyers coming in and getting up on a roof for the first time and seeing that, oh, this needs to be replaced. And now our deal's not going to pencil out. And as I mentioned the year earlier, that, good money after bad, you get out now and, look for the next deal.
And as you're talking about, penciling out, it kind of reminds me of something that Tom G had said earlier, and we're down to about 7 minutes left. So I want to try to hit on all the topics we promised to, but one of them is, if there's a gap in that capital stack, right, between, be it the bank financing, family office, whoever's acting as the lender and the borrower's capital, that, and I think it's probably an issue a lot of different places, but especially where we're sitting at the moment, is, how do you bridge that gap? And what can you use? Is it grants? Is it incentives? Is it IDA deals, tax abatements, all those sorts of things? Or is it throw it at the wall, see what happens, and hopefully you fill up that thermometer when you get there? I'll toss it to you, Tom I.
Yeah, I think the answer that I'm seeing is a blend of everything. And I think searching for all of those and the fit of all of those together is kind of the key. We talk about internally, ideally having sort of a dashboard of options. The challenge with that is that the different programs and especially on the incentive side, they're constantly changing in terms of funding sources, requirements. And so the discussion we had on our dashboard was that updating it would be a full-time job and make it actually not as useful as you would hope. But I think trying to balance, one other thing I wanted to mention was, again, as much as you're looking at a blend of all of the different options, you need to then also weigh how do those fit together, because each of those are going to add their own complexities, their compliance requirements. Whatever the program may be will have its rules. And sometimes when you're trying to layer those together, they don't necessarily play nice with each other, or one of those components may change things. So for example, there could be some incentives or grants or other components or a financing structure that one in particular may add a lot of time to the overall closing process. And so then you're kind of weighing, okay, if I'm going to commit to that much time to bring this source in, should I be layering more to it to do that? Or if I remove that component, is there a way that I could find a couple of others that get it close enough, but don't have that substantial increase in time or complexity? And so I think that's where I don't think it's going to be a regular deal plus one thing. It's going to be an evaluation of a multitude of things, but then balancing between each of those components is really the key.
I appreciate that. I think that makes a ton of sense. Absolutely. All right, so we're at about 4 minutes left. What I'm going to do, I'm going to give each of the panelists just a chance to kind of say what they may see happening, short, long term, any other final thoughts. And if anybody during their final thoughts can touch on Shayna's last question about whether we're seeing an uptick in activity in medical and nonprofit sector, they would get a gold star. So I'm going to start, Russ, with you, and we'll kind of work it around that way.
Okay, thank you. Yeah, I mean, I think it's, kind of the same theme as what we've been discussing is, community banks are looking to grow under certain controls. They want to keep their balance sheet in good order from a regulatory perspective relative to liquidity and how much commercial real estate we have on the books. We are seeing, we talked about office space. Obviously, in general, office space remains challenging. However, medical office space is a whole different ballgame. And we are seeing, some good opportunities for us as a lender in the medical space asset class. And we look at that much differently than we would generic type office space.
Russ gets a gold star. Tim, you're up.
Just looking ahead in the market, I would just say, I think deal velocity will improve once there's more certainty, stability, whether it's rates, pricing, construction costs, insurance rates, certainty on what incentives are available and will be available, and even regulatory certainty. My best legal advice that I can give on the webinar is just early coordination. The more due diligence you do ahead of once the market kind of stabilizes, whether it's site control, you get your title kind of started and reviewed, environmental, zoning, conversations with local IDAs on what incentive may or may not be available, the better you'll be once everything is corrected and you can hit the ground running.
Yeah, I think no gold star for me. That's not in my wheelhouse. But yeah, I would say, while we're looking for this certainty in an uncertain environment, whoever can be the most creative and most adaptable is probably going to be the most successful. And so trying to balance those with the uncertainty, I think is a priority to focus on probably for the rest of the year here.
I propose getting more students out of college and putting them into the trades so that we could get more true workers that can go on these jobs and reduce the cost of the trades. And that'll allow the construction to happen and make the projects pencil out a lot better.
All right, fair enough, fair enough. Well, thanks again to our panel for taking the time. We're right at about 10 o'clock, so I want to thank everybody who joined us on the webinar. Hopefully you found some value here. I'd encourage you, if you have any questions, reach out to any one of us. We're easy enough to find on LinkedIn, Google search, AI, whatever you got to do. These guys are easy to find. I found them to get them on the panel, so it shouldn't be an issue. Another reminder, our next Phillips Lytle Real Estate Webinar Series, it's June 24th. It's going to be how to make your data center project a reality. So one of those hot topics, and we'll have some of our experts touch on that. But in the meantime, hope everybody has a good day, and thanks again, guys.
Thank you. Thanks for having me.
Thanks, Russ.